Good evening. It's a pleasure to be here. Why don't we start by letting each of you gentlemen take a couple more minutes and introduce yourselves and what you do.
Okay, sure. So again, I'm Gary Miller. I have spent most of my career on Wall Street in structured finance and securitization. I got the blockchain bug a couple of years ago and transitioned to a firm that focuses on digital asset investment banking. So it's primarily raising capital for these companies, typically startups or incumbents that are, transitioning to incorporating a blockchain function in their business model, and varies from financial services companies to you name it. So anyone that operates in that ecosystem we'll talk to. So we're called GB Capital Markets. I also started a new role as a senior advisor to a company that's headquartered in Singapore. They're really based out of India. They've moved to Singapore, called Fintech, and they're using artificial intelligence and blockchain to kind of build a platform to manage the securitization structured finance lifecycle process. So I'm going to be helping them incorporate, bring their business into the U.S. and work with some of the folks here. So thank you.
Hi, Wilson Lin. I work at a city agency called the New York City Economic Development Corporation. And our aim is to make New York City flourish from an economic growth, jobs, company attraction perspective. As we all know, cyber is a huge challenge for basically everyone, consumers, corporates, governments, all across the board. And so we see a huge opportunity here in New York City to help make our digital and real physical lives safer. So it's a $100 million investment. It's a combination of private sector money and city investment. And we are doing a number of things. So we are helping startups grow. So we're going to establish the first growth stage cyber accelerator here in New York City. We'll be working with a leading venture capital firm to do that. We'll also be working with all of the major academic institutions, so NYU, Cornell Tech, Columbia, CUNY, to support the talent pipeline in cybersecurity. We know there's a huge talent gap right now, and so we want to make sure that we as a city do what we can to help fill that gap. And in particular, partnering with large corporates to be able to train folks as well as help scale startups. So we'll be working with a number of corporate partners. Goldman is working with us, Facebook, a number of other large major corporates. And then the last piece is working with very early stage companies. So there's a lot of exciting research that's being done right here in the city. And what we want to do is take the intellectual property that's being developed and help translate those into commercially viable opportunities. So that'd be a mix of licensing as well as very early stage companies. So I'm excited to be able to work on that. And as a whole agency, we're looking at cybersecurity, AI. We've done a couple of initiatives in blockchain. So it's a real pleasure to be able to work at the EDC. My past background was management consulting, mostly in financial services.
Great. And just 1 minute on me. My name's Dan Kraut. I run an advisory called Market Analyst Corp. Been doing that for about 4 years, working with both large financial institutions, mainly on the retail side, on innovation projects, whether that's in-house or working and partnering with smaller fintechs. And about half my work is with funded fintechs on going to market and working with bigger companies. Before that, I ran operations at both startups in the payment space and business units at E-Trade and Fidelity on the retail side. So let's start off with just high 50,000 foot view. What segments do you see still open for innovation and disruption from fintechs? Why don't we start with you, Wilson?
Sure. I mean, I think without picking like a very specific category, I think there's still a lot of opportunities in terms of speed of decision making that then finally reaches the consumer. So for example, when I think about recently I switched my renter's insurance, and I was just so pleasantly surprised at how quickly. So I did it on Lemonade, and it took no more than a few minutes. Obviously, the dollar amount is much smaller. So if you think about applying those same principles to something like a mortgage, so I remember thinking like applying for a mortgage a couple of years back and how absolutely unenjoyable that process was. I think we as consumers and even from a user experience perspective, we are now being accustomed to something much more seamless. And anytime we start to face these processes where there's paperwork, I need to wait for someone to email something to me, I need to email it back, I need to wait, it's just a pain. So you can see certain consumer-facing financial services that are still very time-consuming, paperwork-intensive, things like mortgages, longer, more complex approvals. I can see that certainly being streamlined. But I think ultimately, an area that I think maybe is less expected, that I think I'm pleasantly being surprised at, is redefining the human agent in fintech. So I think in one sense, there was a trend towards basically eliminating the human element, right? So a lot of like the robo-advisors, et cetera. Now I think, as some folks are already doing, bring humans back, but thinking through what is the optimal way of a more enabled human using all of the technology to be able to serve the customer better, so that it's less of a pure speed, price, whatever decision, and more of an experience, so that you have that better customer retention. So I think that's an interesting trend on the horizon.
Great.
Yeah, I come at it more from a capital markets perspective, and I think, well, one, the obvious use case is capital formation. I mean, we've seen that change already with websites and crowdfunding. Now, in the blockchain space, you're seeing a lot of asset tokenization, fractionalizing ownership of assets or securities, and the ability for people globally to invest in those securities. So it really gives a lot more, democratizes access to capital, and then the KYC. How if you invest or open an account, you have to go through a KYC or anti-money laundering process. We're seeing a lot of that automated now. So someone can get kind of a KYC passport to participate on a platform or website, and invest along it. So, especially in the private capital markets, with startups and private placement securities, it's just really opened up. And I think that's going to continue. We're seeing more in the blockchain world. We're seeing more and more of these companies come online, and real estate is really the one that seems to be getting started now. Going into next year, I think we're going to see a lot of real estate tokenization that's happening here in New York. So someone can be, in Singapore or Phoenix and have the opportunity to invest in a building in Manhattan that they would never otherwise even know about. And that's also facilitated, I guess, by a second part of my answer, which is payments. And the payment system is surprisingly cumbersome, even in 2018. I had my oldest son went to college in Canada. We'd go visit. Every time I'd go to a restaurant, of course I could use a credit card, but I'd always have an extra $4.95 charge for foreign exchange or whatnot. And I was always wondering what the exchange rate I was really getting. And there's just a lot of friction in terms of cost, even though it was relatively easy to do. So what we're seeing now is new payment applications using digital formats that allow a lot less friction across border. And you're seeing that combined with retailers where they can create marketing incentives if you use an app that includes, whether it's an ecosystem token within it, or let's say you're in Korea, you bought credits in this platform that's good and you visit the United States and it's spendable at 70,000 retailers. So, and that's a real pain point. 2018, we're a global society, people are traveling, and just, money's a pain point. Spending money is a pain point. So I think a lot of the technology we're seeing provides real solutions to that pain point. So that's why I think it's going to be adopted, because, anyone who travels, really has that problem.
Okay, great. If I could just sum those areas up, I think that you both talked about functionality that leads to a much better consumer experience, whether it's the lemonade, the mortgage, the spending money outside your native currency. The other area that I heard you both talk about were what I would categorize as people collecting excess rents. And so it's not that there's no place for a human in advice, but maybe not paying 120 basis points for advice, doing some of it automated and some of it at a lower cost person to person. In order to deliver on the promise of fintech, what do you think these companies need to do in such a regulated environment to act and fit in a way that the regulators and others are comfortable?
You might have a better, I really don't know what is the best way. I think there are some certain tactics. So certainly one is building with a different approach, right? So you can't build a fintech platform the same way you would build a photos of your cat sharing platform, right? It's not a build it super fast, break things, and that's just not going to work. So one is building with regulations in mind and anticipating those. I think that's one. Second, I think if you're able to do that, finding ways to gain credibility is tough, right? Because I think financial services, a key piece of it is it's fundamentally a huge part of it is about trust. And when you're a startup and no one knows who you are, how are you going to get any sort of traction? I think a huge part of that is getting corporate partners, being able to say that I signed with Goldman or JP or whoever. That demonstrates credibility to the market, but two, then it probably more importantly, it actually demonstrates credibility to other corporates, because you've then demonstrated you've gone through some sort of more rigorous approval process. So I think the last thing is I would say participate in regulatory interfaces, right? So some regulators will actually hold sort of these unofficial office hours, and being able to have a more direct interface, a discussion, potentially bringing counsel in early. So I think stacking that earlier versus later from a remediation perspective, I think that can certainly help.
Yeah,
Gary?
No doubt. To get credibility, well, I recommend people talk to lawyers early. If you're in an environment that you even suspect is regulated, go find out. In a lot of the consulting I've done in blockchain, I sometimes would jokingly refer to myself as blockchain Buzzkill, because people would come with these great ideas. They're young Stanford grads, and they've got this incredible idea. They've already put a lot of development time into a platform to disrupt the insurance industry. And then, someone like me, I say, well, how's the licensing going? Because that's licensed at the state level. And it's, you need a license to sell insurance. Lending licenses. You'll notice a lot of the online lenders, if you read the fine print at the bottom, loans are actually, originated by such and such a bank in Utah or Nevada or something, because they're really an origination platform. But the lender of record is the Federal Savings Bank, which allows licensing throughout all 50 states, safe for lending. So, I think that the thinking is, it's just the idea is not enough. And you hinted on, or pointed out credibility. So, I recommend go find someone with 20 years experience in that segment to get some of their wisdom and advice that can just, sometimes a 30-minute conversation can preempt a lot of wasted effort or create a pivot or determine next steps. And also, advisors, people that really come from the industry that have the subject matter experience, you can tap into their network, and that's where you get the credibility. Mm-hmm. You can't just have a pitch book or a white paper and a great idea and just show up at Goldman Sachs and you're going to, pitch this idea to them. So it's important to, have have your ideas and your ambition, but just temper it with getting the facts before you put too much effort in, and recognize that the regulations are there for a reason. You have to respect them. We saw. I don't know how many of you have followed the ICO markets in the blockchain space. 2017 was just crazy. The ability to raise money with no product, just a 20-page white paper, and there are laws, there are securities regulations that in many cases weren't followed, and so people, all of a sudden the SEC and others came out with guidance like, "Whoa, people, stop! There's rules. This is you're violating the law." Now, in 2018, we've been seeing enforcement action, and trust me, no one wants an enforcement action from a federal regulator. So again, that points to, if you're operating in a regulated environment, get some advice early. And a lot of people, if you call a lawyer, a banker, just for a quick conversation, you're not going to get a bill. You get a lot of good advice. That's that front end advice that can really shape the path you should take.
Great. Some of the advice I give my clients is you always want to be the riskiest business that your issuing bank has. So I do a lot of work with payments where there has to be a banking relationship, and the fintech companies act as basically facilitators of a consumer bank relationship. But at the end of the day, they capture most of the upside. And one of the things I tell them is, you always want to be the riskiest program that your bank has, specifically so that banks don't get shut down, because sometimes that happens as well. Mm-hmm. There's some notable cases in the prepaid industry where I spent a lot of time, where banks have been shut down, or at least forced to take a pause and not allowed to take on new business. Let's turn and talk a little bit about cutting edge technology advances. And what do you see? I guess there's a ton happening in the distributed ledger, blockchain, Bitcoin area.
Oh, yeah. I think, blockchain in and of itself is a cutting edge technology. And I think people are trying to use it all over the place where maybe it's not necessary, but there are some areas where it really provides a lot of value. And with all the hype about blockchain, if you really boil it down, it's a little boring. It's managing data and recording a ledger, but it's got beautiful attributes in that it's kind of a trustless system that the trust is built into the ledger. You don't have to rely on third parties for that, so it can provide a lot of transparency. In the enterprise level financial services, there's a lot of kind of permissioned private blockchains rather than public blockchains that allow parties to share. So we call distributed ledger a shared ledger. Instead of let's all do the same math every month to cover the transactions we're involved with each other in, let's have one ledger that we all have access to. So that's an important one. But I think what's probably more profound maybe is artificial intelligence. And it can provide. I was talking to a loan servicer this morning, and they're using artificial intelligence to monitor collection calls when their agents make calls to people that are delinquent. And there's this kind of semantic learning. The AI agent understands what's going on with the portfolio and can read cues based on the answers the consumer says that provide kind of a qualitative assessment of the direction of the portfolio that just the simple servicer reports each month could not cover, like trends in delinquency, trends in the reason for delinquency. And in the past, most of these companies would have a compliance team or whatever. They may monitor, 0.5%, 1% of conversations to provide guidance to their employees, like, hey, you're not saying this disclosure properly, or this or that, or try and derive some assessment about the portfolio if there's any problems in it. So artificial intelligence right there, from a language perspective, can derive meaning out of conversations, so now they can monitor 100% of conversations and derive meaning. And then on the document space, when you're dealing with, like, say, non-performing loans, where a purchaser has been buying all these different mortgage loans that have defaulted and packaging them up, trying to work through them. They can now onboard, use artificial intelligence and optical character recognition to read documents, gather the relevant from a bunch of different fragmented issuers, pick the right pieces, and kind of create harmonized data, onboard that into their servicing systems or ledgers. And sometimes it feels a little scary, some of the AI stories you hear, but it's coming. And I mean, it's here, and it's coming. And I think that's probably will prove to be the biggest technological advancement we're seeing over the next, decade or half a decade, in my opinion.
That's a great example. Mm-hmm. Wilson?
I think sort of like underlying some of what enables these advancements is also just how quickly computing power in general is escalating. So for example, in the cybersecurity space, you're now seeing technologies actually being utilized that a couple decades ago were just academic papers, that if you were to actually try to build that into your cryptography back then, it would have taken an insane amount of computing power and taken a much longer period of time. Now you're actually able to operationalize those and provide a much higher level of security and a much lower cost. So I think there's a number of even technologies that are not necessarily, or concepts that are not necessarily new, but because of the way that computing power has escalated, you're able to take these really innovative, creative ideas and now start to make them a reality. Even if you think about sort of predictive modeling and simulation. I remember when I was an intern many years ago working at a wealth management firm, people would run this like Monte Carlo simulation, right? So like back then it was like the thing, and it would map out a distribution of probabilities of where one's, in that case, like where one's wealth would end up, and then it would help determine how much you can spend, how much you should save, etc. Now you're able to basically do simulations that are orders of magnitude more powerful than that. And so you can imagine vastly more data points, more accuracy. You're able to change the inputs much more flexibly. So instead of mapping out an individual's wealth path, you can see some of like the larger tech-enabled hedge funds, Bridgewater, et cetera, utilizing the power of these simulation-informed investment decisions be quite interesting.
And they can really increase the frequency and speed of which you can execute a trade. If you're trying to do arbitrage, where you're buying and selling something very quickly to make a small profit, but do that a high number of times in the day, and a large aggregate volume, the speed at which you can not just execute the trade, but the speed at which you can make the decision for the trade. Humans can't do it as fast as artificial intelligence agent. So, yeah.
I think one of the other, not necessarily cutting edge, but probably a different approach that I think I've seen companies start to take, at least from a consumer-facing side. If you just think about all of the publicly available data that exists on you as an individual, whether or not you want it to be out there, it's there, right? So you think about companies, assessing someone's credit. Like, yes, you can have a FICO score, but you can also look at where I went to school, who my friends are, right? Like where I dine. Like my online activity can give indicators of a particular profile of a consumer. And so I think from both the marketing as well as if you were to assess me as a consumer and think about try to calculate my customer lifetime value, the amount of data out there is so much more accessible than previous. So I think that's another.
And there is strong correlation with credit performance. So I'm working with a company that we're in discussions that is using artificial intelligence. I mean, they pull FICO score, but they use a lot of other qualitative assessments too in their underwriting, and it's automated underwriting. There's no human input, even down to funding the loan through an app. So someone could apply for a loan and have the money in their account in about 8 minutes, no human involvement. And when I look at, I don't want to be too much of a structured finance nerd, but there's these things called static vintage pool data, where you look at the performance of collections or delinquency of, say, the loans originated in January, the ones in February, the ones in March, and you can then you lay those curves on top of each other, and the tighter they are, that gives you comfort that you can structure and model bonds or what kind of security underneath that. So, math really drives structuring and credit ratings, and their performance data. I mean, it's as if these curves were, you can't differentiate the different vintages. It's just mapped out so well because they have an AI engine who doesn't have that human error, human volatility in their credit decisions. Depending on how they're feeling one day. And many years ago, I had credit authority at an institution when I was in grad school as a consumer lender, and there's just volatility in your credit decisions based on a number of factors, how you view things, and when you can put that into an algorithm and an artificial intelligence agent, you can get really incredible consistency. So this was one of the first exposures I've had to what I call AI credit scoring, that when I saw, the end result, the numbers over, 18 months of origination, I was dumbfounded. I was impressed having done it. I'm old enough to have done it the old school way, 25, 30 years ago, and very impressive.
Great. So I heard both discussion of really cutting edge technology like AI married with not so much cutting edge technology, but a change in the underlying technology, and that is more data. And I'll add another one. I see the use of APIs now, especially going from a lot of the incumbents working with fintechs to get people access to information as just extraordinary. If you go back, and I also am of a certain vintage, if you go back into the late 80s and the 90s, and you think about what Intuit had to do with Quicken to pry open the doors of banks, and what Yodlee had to do with screen scraping. And now we've got startups like Plaid and Quovo, which have the ability to go in and through APIs that they've negotiated with JP Morgan Chase, with Fidelity, with all the biggest and most conservative financial institutions, provide people with access to their own information. I think that's just amazing.
Yeah, interoperability between systems is very important. It can be real barriers if you don't have it. If you need a piece or a data feed or some slice of information out there, and getting it to fit into your system, that's a big deal. So yeah, it's amazing how like you said, some of these startups have access to information and create trading systems that are with connectivity to 100, say, crypto exchanges around the world in almost in near real times. Fascinating.
So I wanted to turn now to what I think is potentially the most interesting question I was going to ask, and that is, what points are often overlooked as being not critical, but in fact might turn out to be fundamentally critical, either in an opportunity way or in a gotcha kind of way?
So your last part again?
Gotcha.
The gotcha, the bite you in the butt.
Like, you need
way.
a license to sell insurance.
You need a license, which is why so few insurance companies are working here in New York State, because we have the toughest insurance commission.
Mm-hmm. Well, I think, my perspective working with a lot of companies raising capital is, or more from my consulting work where they haven't seen the need for capital, that so I think it's often overlooked. Like, we really need capital. We need to create a runway to get to some threshold. It's not like you have to go out and raise, the money just because it's there, but really have a well-defined plan of what your sources and uses are going to be, and change it as you go through the process. But you ought to say, okay, I want to get to a minimum viable product, or I want to get to this stage, or I want to get to one customer. I want to get to be a post-revenue company instead of pre-revenue. What does it take to get there, and really go out there and raise capital? Because there's been so many great ideas and good management teams and companies that have failed to get off the ground because of lack of capital. It's just it's often overlooked. A lot of people just think that great idea is enough. And then back to what I said earlier about finding someone with a little gray hair for a little advice, someone with the subject matter experience in the problem they're going after, and getting a feel for the regulatory framework. You don't have to have all the regulatory answers and laws right there, but in front of you. But you have to know when to ask and get a general framework for them, and then you can increase your knowledge of that as you go through the process.
I think obviously as leading cyber NYC, I think people building their companies and their product without an eye towards security up front is a huge miss. I think sometimes will just take it for granted that as they engineer a particular product, that they have already covered their bases because maybe they took a computer security class and they remembered a particular way to code something. Obviously, we now know that it's much more complex than that. And if you're just starting off, you building a product, you're just thinking about, does this work? Will this attract my clients? And maybe can it scale? And sometimes security just takes a back seat until you get to a big enough scale and there's a breach, and then you have some major issues. And I don't think that certainly large companies don't fare any better, as we have certainly seen. And so I think taking a really critical eye towards cybersecurity early on is huge, and not just in trying to play out certain idiosyncratic case scenarios, but taking an overall look at your entire sort of surface area of where you might be vulnerable, especially in financial services, where, as we said earlier, trust is so critical. And so a significant breach early on for a young startup, it'll hurt. It'll hurt because it'll delay putting your product out again. It'll delay any major contracts that you have. So building things from a security mindset, I think, is critical.
Great. Time to make some predictions. What do you think the landscape for fintech will look like in financial services in general 5 years from now?
So a couple of things. So from the consumer side, again, I think there'll be a merging of the human and the machine. So even if I think about my own experience, I was early adopter on the robo-advisor, and so money is there. And now that I just had a kid 5 weeks ago, and now I'm rethinking my entire financial picture, right? So I'm thinking about life insurance, estate planning, to the extent that is currently not really that relevant. But I'm trying to think about the whole picture, and Wealthfront is just not going to do it for me. So now I'm looking at startups that are enabled, like Grow Financial, where I can still talk to a person, but my assets can still be managed by a robo-advisor. So there's this merging of the human element with the AI, the robotics, that I think is going to be really powerful. Second thing I think is I'm probably the merge of both, something about the emergence, or the merging of the software and the hardware. So if you think about your watch or point of sale devices, I don't think it's going to be just sort of hardware on one side, agnostic to whatever the software is. I think there's going to be a confluence there as well.
Yeah, no doubt. And to your point earlier about cybersecurity, I think one of the big areas that just came to mind is digital identity, self-sovereign identity. There's a lot of people globally working on these projects because trust is broken. There's been these, big trusted institutions, and they've been hacked, and your data's gone. I'm sure half the people in this room have had their information hacked, and it's sitting somewhere on someone else's server where it doesn't belong. Whether it's been used against you or not yet remains to be seen. But so there's the idea, like if you had a trustless system, like say blockchain-based encrypted identity, that you could put important documents and show them at will. Like, for instance, one example is, say a young person goes to a bar. You're supposed to be 21, right? You get carded. So, well, when you get carded, there's your name, your address, your birthday, when really all you need is a zero knowledge proof. You only need to be 21. They don't have to know you're born May 11th or that you're actually 25 and know your address. So I think people, and it's a big issue. People want to take back their identity. I think people have been really put off by not just financial and personal data, but even data that's been used against them, say in social media. So I think we're going to see more, 5 years, I think 5 years from now, 10 years from now, I think we'll all have kind of digital passports, so to speak. And when I say passports, I mean where our credentials are controlled by us and only by us, and they're on a decentralized network with not in the hands of a siloed, quote, trusted party. Again, artificial intelligence, I mean, I just think that's a biggie. And as you pointed out earlier, Wilson, it's not necessarily replacing humans. It's doing some things better than humans, but it changes the role of the humans. It aids. It can make, say, a human, say, a wealth manager, do a better job, say, by having these tools. It can make people that work at a credit institution do a better job and offer better rates because they have lower delinquency because they have better, say, automated underwriting engines. I just think, the world is changing just very quickly now. And I think we're going to see the changes we're seeing in blockchain, artificial intelligence, going to happen more quickly than, say, the internet did, because the internet has really took a little more time to get adopted. We didn't know what direction it was going when it started. We thought it was all about email, right? And we didn't know it was about booking flights and showing pictures of what you had for breakfast to all your friends from high school on Facebook, So I think we don't know yet what the future holds, but we're going off on this path. But I think it's going to happen more quickly. So yeah, blockchain, artificial intelligence, digital identity, I think those are all real biggies.
Okay, I want to add to that I think that that prices are going to continue to come down for consumers. Margins will be compressed for providers, whether they be big financial institutions or small providers. You're seeing that already with the robo-advisors who have a fabulous offering in terms of utility, but a valuation that just is crazy relative to the amount of assets that they'll need to manage to justify those. I think that the margins are going to continue to come down, and it's going to be a combination of, as you both talked about, automation with the smart application of people.
Yeah. And if I might add too, you touched on this earlier, and I think we're going to see more of this, where in a lot of ways the banks are bigger than ever, but all the originations is being done by OnDeck and Lending Club, but it's the banks that are buying, the same asset-backed investors are buying the paper, pension funds. So it's almost like I see the banks becoming more almost like buy-side shops, and I think a lot of that, what you would think of as structuring and origination, whether it be small business loans, consumer lending, whatever, or wealth management clients, will be, technology is pushing that process directly to the consumer. But, the banks and pension funds, they're all still there, and bigger than ever, but their roles have changed,
Yep.
They're almost more like investors and facilitators than they are, say, origination and structuring anymore. You see a lot. I think technology will just outsource a lot of that function.
One of the most amazing things to me is Goldman Sachs' Marcus effort.
Mm-hmm.
And you're taking a bank with some of the highest margins, and they're going whole hog into a business with some of the lowest margins in finance, in terms of competing with the other fintechs.
Yeah, well, technology allows you to do things at lower margins, or because you pick up these efficiencies. I mean, there's some kind of consumer payday lenders that lend $300 or $400 for 30 days, and and make $20. In the old days, you just couldn't do that. You couldn't pay a person to sit there and write the application out and where do you work and do all this. to make $20. It's not there. So it's allowed a more granular push direct to the consumer process and expanding asset classes into areas where you don't have to be as large. Even the structured finance securitization business that I come from, I mean, there's kind of a rule of thumb. If something under $100 million, $200 million, sometimes just the hassle and cost of doing a securitization issuance wasn't there. I think we'll see technology facilitate a lot of that where, hey, maybe you could do a deal at 50 million, 75 million so that would allow access, more liquidity to more users of that liquidity. And I think everyone benefits from that.
Yeah. And
I think sorry, go ahead.
Go ahead.
I was going to say, in terms of trends, I think one of the things that won't happen is sort of a utopian disappearance of banks. I don't see that happening for a number of reasons. But I think the smart banks are doing sort of this partnering earlier on. I think previously, it was an ignore strategy, and you just can't do that anymore. So where it's Goldman and Citi making a couple dozen acquisitions over the past five or investments over the past 5 years, acquisitions, building out a startup-like interface for the consumer. I think you're going to see more of that. I think that's smart, just both from a customer acquisition perspective, but perhaps even more importantly, it's also from a talent acquisition perspective. I think that is probably a hugely underrated benefit of doing some of the fintech M&A, is actually bringing in the talent that can think in a way that will address a new generation of consumers.
Yeah.
Do either of you have experience with legacy systems, either on the investing side or the banking side? From where I sit, the investing side seems to have done a better job of adding new capability at every stage in the value chain or the supply chain. And if you look at
the buy side investing,
yes,
kind of
exactly.
Scenario.
And if you compare that to the banks, they're still crippled by their core systems.
Well, if you look at investable assets over the last, in spite of the crisis, I worked some in the asset-backed commercial paper market, and we got up, our industry got up to about 1.6 trillion. And after the crisis, 3-4 years after the crisis, it's at 200-300 billion, and it stayed there. We lost over, 1.2 trillion, and those were money market instruments, highly rated money market instruments. But the demand for money market instruments did not go away. It was at 2 trillion and climbing. So there's been a supply-demand imbalance, and there's still. That's why we've seen so much advancements on in the buy side, because we've had a good 20-year run, and there's just a lot of wealth, and with a lot of the regulatory issues and Dodd-Frank and some things that. The banks, to some extent, and issuers, and kind of the shadow banking system that provided, investment opportunities were kind of crippled and almost went, a lot of the new banking regulations and securities regulations took 3-4 years to be implemented. There were comment periods that would go on, and it was in stages. So, you don't want to undertake and just charge into a new business or to keep doing things a certain way if you think it's going to be changing, and it took 3-4 years for a lot of those regulations to get in place. So I think there's been a lag, and I think it's permanently hurt the banks to some extent. But the banks have capital. When I talked earlier, one of the things people overlook is capital. Well, the banks have capital. They're not the best at generating new ideas or creating new technologies, but they're happy to buy it. So, like for instance, Marcus, was that a team bought by Goldman? Do you recall? Or
parts of it were. Parts of it are internal, and parts of it are acquired.
10 people probably got something going.
They have 1,000 people now.
Yeah. So that's the power they wield, and that power is derived from capital. So I think the incumbent threat is to ignore, like you said, you don't want to ignore what's going on, and I see some that are, and they're busy. They've got their legacy business going, and who's got the time or inclination to think about new things. And I think those people, will fall by the wayside. And the banks that are smart enough to recognize what's going on and have, innovation teams, even if they don't innovate themselves, be aware of what's going on and then go out and buy it. I think that's the strategy I'd have if I were running a large banking institution.
I mean, it's crazy. I mean, I remember doing in terms of thinking about like acquisitions and like what does your stack look like? The vendor management is like a whole practice of its own, and it can get really, really messy. And I don't think so. A couple of things. Bank legacy tech is surprisingly atrocious. I remember going into one of the what you would consider a top tier bank, and just being astonished that these people are managing the amount of money that they're managing, and still working on defining, what defines a household, what actually is an address, how many different places is this piece of data stored all over, what particular database has the true, whatever golden source of data, and how messy it all was. So I think that they're incredibly disadvantaged from a legacy systems perspective. And then, I mean, I'd say from an integration perspective, because so much of bank tech has been built internally, it wasn't built from a perspective of thinking that there's going to be some other system from the outside that they would necessarily need to integrate with. And when things are built internally, it means it was some particular person in there that built it. And right now, that person is nearing retirement or retired. And so if you think about the challenges just from an institutional knowledge perspective or lack of, that only exacerbates a problem when you think about, yes, they certainly do have capital, but to be able to effectively integrate throughout the tech stack, it's really tough. And I think that's why you don't necessarily see a lot of the theoretical savings, ops improvements being realized yet.
Interesting.
Yeah, and that's probably one of the downsides of being a really large financial institution is it's like trying to turn the Titanic quickly. You have these legacy systems in place. You have 200,000 employees, and it probably takes years to implement a substantive change or pivot. So I know a lot of them, they just have all these pockets and silos of legacy systems, and they have 1,000 employees that their jobs are simply just to make those systems try and talk to each other. When maybe just a complete, clean out is the way to do it. But it's like Manhattan. How do you, let's say you wanted to redo the Holland Tunnel. You're gonna shut it for 5 years. Really. How do you? That's what I'm saying. When sometimes things just get so massive that the thought of an undertaking of significant change can be a hurdle in and of itself.
Mm-hmm. All right. Well, thank you guys. Thank you for coming this evening.
Thank you guys.